All the audits, you know the thing is the syllabus. Let me see. Okay, so the syllabus, the thing is part A will be 3 case questions consist of each case is 5. Each case is they have 5 questions. Each question is 2 marks. So that this will be your objective test. I mean, is you choose from ABC. Later part we have some of the objective test questions. Then you can see from the books. Hey, Kui, have you got the books? You got the books, you Korea, you receive books. Okay. So okay, then the thing is you can see for the part A is consists of the 30%. Part B is 70%. That will be the 30 marks. 1 question, 20 marks, another 2 questions. So total how many questions you were expected to have is 15 questions from the part A, but of course multiple choice, 15 question mark. And then you will have 1 question is 30 marks, and then 2 questions is 20 marks. So total will be 100 marks. So 100 marks, each one, let's say the thing is 100%, you will need 180 minutes, 3 hours. So the mean is every 1% is 1.8 minutes. So if you think the thing is, you were given the 2 marks, the mean is you will only have 3.6 minutes to answer once. So very fast. So if you cannot answer, jump. Have to jump. Don't just keep thinking of the past, see whether or you jump after that you come back again. Because every 2 cents, 2 marks, you will need to spend not more than 3 minutes. 3 minutes. Similarly for these 30 marks question. For 30 marks question, you cannot be more than 45 minutes.
So this page, are you referring to the course notes?
Course notes. Oh, we are going for the course notes.
Which page?
Syllabus.
This one, right?
Is it? I give you the wrong one? Correct, man? You got that?
Oh, this one. Okay.
So here will be these 30 marks. Okay. So far, so good.
Okay.
Any question for this? Let me see another person's. Did they get back or not? Are you coming? The time is not here. Okay. Now the thing is, before we move on, any question for this?
No.
So far, okay? Okay. Cool. Okay. So okay, don't worry. We just go ahead with this. Chapter 1 for the what happened for the why the thing is we need to study the audits. Okay. The reason is study the audit is very simple because the thing is you are the investor. You are investor. So you will engage the board of directors to do things. Board of directors. You are the investor. So you set up the company. So you engage the board of directors. Of course, if you are the one of the board of directors, it's okay. But a lot of time for the NMC, they are investor. So the thing is, they will engage the board of directors to do it. So the thing is, for board of directors, because what is the board of director responsibility? Management. They must maintain the account. They must. What the main responsibility is, they must maintain the account. Okay, so the thing is, the thing is, in order to maintain the accounts, so that the thing is, if the account shows good profits, good performance, what they expect? They will expect for the rewards. Reward, I mean, is increase. The reward, I mean, is they want a good salary, they want to have a benefit in kind. Correct? So, but the thing is, in order to maintain because who is the responsible? Director will be responsible to maintain the account, to prepare the account, so that they can show it to the investor. So, hey, you can see, I have done this, the company performance very good. So, and then in this case, the investor, okay, as an investor, are you trust the account that prepared by the board of director?
No.
You will not trust because you will have a creative accounting. Creative accounting, the mean is you can manipulate the account. Correct? For the creative accounting, you can manipulate the account. So when you're manipulating the accounts, so the thing is, the shareholders will mention the thing is, I don't trust what they prepared by the board of directors. So the mean is they will engage the independent party to vet through independent party, so that the thing is to give the opinion and professional judgment. In order to give the opinion and professional judgment of this account, they will have to make sure the independent party give their opinion and professional judgment, independent judgment, to vet through the account and to report to the investor. So that is the reason why the audit is coming in. The audit is coming in because it's a three-party relationship. Investor that appoint the board of director, then the board of director will prepare the account, and practitioner, auditor will give the professional judgment and opinion to the investor about this account only. Remember, auditor is only concerned about whatever in the account. Auditor will not involve in the management decisions. Auditor is simply just doing for the accounts only. But auditor have all the right to access to every individual account. So that is their rights, in order to give the opinion and the professional judgment. So therefore, that's why the thing is, for this audit assurance, is they will happen in what, they will always have a conflict between the board of directors and the auditor. So that is the reason why later parts you can see audit committee is setting up. Because audit committee is trying to manage two parties to resolve their dispute. So that's why. And for investor it's very simple. What is their objective to set up the company? Because they want to maximize the wealth of investment. Investor, when they invest in the company, their purpose is they want to maximize the benefits, the wealth of the investment. Of course, I want to earn as many as possible. How about the board of directors? What is their objective? Of course, they want maximize the benefit as employment. Correct? Board of directors is employed by the company, and the purpose is they want to maximize the benefit as an employment. They want to get high salary, benefit in kind. They want to have a director fee. They want to have this car. They want to have a lot of things. When you want to have a lot of things, and then here is investor, they want to have a maximize the wealth. So, of course, the thing is then you will be having a conflict, correct? You will have a conflict. Conflict in the term like if board of directors they want to maximize the benefit in kind and as well as the package. So it will be increase the cost. When they increase the cost, investors they are not able to achieve the maximum of the wealth because the cost is involved. So when the cost is involved, so the thing is then how they can manage for these parts, how the investor ensure the board of directors are not overpaid and are able to retain them based on the market. Therefore, this one will be remuneration committee. Committee will be setting up. Just now this one is the audit committee. So now you have another one called remuneration committee. So this remuneration committee will be set the salary, the benefit in kind of the board of directors. You don't underpay the board of directors, you don't overpay the board of directors. So the thing is, if you underpay, you will lose them. They will go for others. If you overpay, the investor will not maximize the benefits. So that's why that we will go through all these items until the end. Because from here, we will go through first one, why the thing is we need the objective of the audit. Second, the thing is how to be an independent party. What is the duty of the auditor? What is the engagement process? Then the thing is how you allocate these planning, your strategy for the audits. And then later on, under governance, why the thing is this one is under follow what governance? For example, what standards we are following, what corporate governance that the thing is we are really follow. Because the thing is certain parts, corporate governance thing is involved in remuneration committee, we will be involved in this audit committee. We will also have the internal auditor coming in. We will also have the person in charge of the governance. All this will be here. And then at the same time, we will also mention about the duty. The main is how about management side? What is their duty of? So this is, and then finally the reporting. So you can see, that's why your AA is cover all this, the whole picture of the AA. Then the thing is, AA will be covering all this because the thing is from the auditor, from these board of directors, as well as the third part, these independent party committee. So it is all the AA will be coverage. So then the thing is, when it comes for these AAA, this P7 AA, then you will go by the case by case cases, especially the money laundering, the process, all these process. So they will not talk about this anymore. When you go to the P7 AA, you are not going through all this again. You are going through by the case by case, especially the money laundering process. Then how you go and find out all this, what's wrong with the auditor. So that's why it is the overall overview for this AA process. Any question on the class? You have any question to ask? Feel free to ask.
Okay.
You okay? So that's why the thing is for this part, you just any question you can just keep asking, or you can if you're shy you can just using the chat. Okay, now here we will talk about the objective of the audit. Not only is they will say express opinions on whether the financial statements are prepared in material respect according to the financial statement framework. Okay, you can see here, they always express, when they say express the opinion, whether the report is prepared based on the true and fair view. True and fair view. True and fair view basis presentation. Every time they will say, okay, based on our this audited report, these report are prepared in true and fair view. Okay, what is this meaning true, fair view? True, the meaning is all the records you are putting in are correct. For example, you have, the thing is, let's say, true, you have the invoices. Invoice for these property. Invoice for property cost 350,000. So yes, your account also recorded non-current assets under property and building 350. So it's true. All your record are true. True, I mean it's based on they went through all your records. Then they realize, yes, your record as per original source. As per original source. We always know it's a historical cost. What is the accounting concept you have? So you must know, as an auditor, you must know about your accounting concept, accounting frameworks. First thing is historical cost. Right? Measurables. Any others? Consistency. You also must know the thing is, accounting framework is a lot, timely. Then the thing is, also is materialistics. Quite a lot of theories on the accounting frameworks. So true, the meaning is whatever you record from the source. And this property is still in your company. Still, okay, for the PPE, IAS 16, PPE.
IAS 16 means?
International Accounting Standards 16 is under PPE, property, plant and equipment. Property, plant and equipment under IAS 16. Okay, let us account first. So, okay, true and fair view. We mentioned about true and fair. So the thing is, the invoice for the property is 350,000. Based on the IAS 16, what is the criteria to recognize a PPE? First thing is measurable. Yes, the property can be measured. IAS 16. We are talking about the objective audits. We have gone through all this. So PPE, measurable. Correct? Because measurable is dollar and cent. Yes, measurable. Under control. Because you must be control the items, then you are able to to record. That is your ownership. Correct? Measurable, control. And then bring the benefits to entity. That property must able to bring the benefit to entity because they can use it for us. They can use it to generate the income. So that's why the benefit to entity. At least you must fulfill these three. Then you can have a PPE. So the thing is, based on the express the opinion, auditor said yes. Correct. You have done all this, and then you classify under the PPE, non current
Assets.
assets. So that is true. True. So based on this, they will be reported. Yes, you are in the true and true. Fair value is different. Okay. So true. So you record based on the standards. You record based on the standards. Okay. So now the thing is, the next question is, how about fair value? Fair value, for example, here, this property 350. Now, that is 10 years ago. Now, after 10 years, the market value same as a fair value. We said market value now is 2 million. 2 million. Let's say 2 million. Because 10 years ago, the bill now is at the central of the KL, 2 million. So how will you be still putting as a 350, or you will revaluation fair value to 2 million? If you still keep under the 350, auditor might have a question. He said it's not a fair value unless you justify. How you justify is whether accepted by the auditor or not. Because auditor said it's different too mixed, too high. So usually, what will be your side? So what will be your side do? You will ask them to do the fair value or not? Revaluation. Because a lot of people don't want to do the revaluation. I tell you the truth. They say no, that is 10 years ago, just based on the part. So then, because they are using the cost model, they are not using the revaluation model. If you are using the cost model to prepare your accounts, the need is, yes, you can use a 350,000. But if your public account is published to other people, investor, do you think you still can use 350? It's better because it's for the benefit of this community for the outside. You must change it to revaluation model. So you will adjust the differences through the revaluation reserve. Your partner revaluation reserve. You cannot recognize profit because it is not the realized profit. This is unrealized profit. You have not sold anything yet. You cannot recognize. So that's why the thing is, the fair value usually is to match your record with the market records. For example, fair value, the best one is the IS2 inventory. This is the best example. If you are using the IS2, International Accounting Standards 2 inventory, what is your recording methods? The lowest of fair value, not fair value, net realization value, or the cost. That is your IS2 regulations. They say your inventory must be recorded the lowest of the net realization value or cost. So then if you follow this rule, then yes, it's a fair value. Because the market is showing, for example, your this Nokia 3310, last time is very hot. Now is, at the time you buy is $500. But now market only willing to take $300 only. So the your closing inventory must have using the 300s. You cannot using 500 because in the market you only can sell 300s, not 500s. So how you recognize the other 200 losses? Impairment of asset, impairment of inventory. You are putting other impairment of the stock. So that's why the thing is, the auditor have to do two things. First, they have to ensure true figures. Second, fair view, because that report will show based on the current situations. So that's why the thing is, as an auditor, it's not easy. That's why you have to give. Once you express the opinion, you will ensure it's true and fair view. If not, then you will assess the materialistic of the mistake, and then you will give your judgment whether you want to only fill the report, whether you want to qualify the report, or whatever you have to think. By the time you qualify them, of course you will be sour with the board of directors really, because they are not happy. So that's why the thing is, this is how the overview. We are still at the overview of the auditor. When we do the time, we will have to ensure that will be the what the auditor responsibility. That's why you can see the opinion every time. I know the thing is when you prepare the audit report, all these statement is the same. Everyone copy the same, just change the name. They will say. But the thing is, the works for this to confirm this too is tedious, and then they carry with the audit risk because. So this is the part as an auditor. Another thing, the auditor is, as an auditor, because the thing is, so far any question up to here? You got any questions or not? So far, no? How about yours?
No.
So here, okay. Next one, before we move on, at least one important part, not in these topics as an auditor, you must know. So okay, auditor must, the responsibility, what is the duty? Auditor. This is just topics. Okay, auditor will give the due care to the shareholder. Correct? Auditor will give the due care. Due care that means is you engage me. I will anything wrong you can sue me. Due care. So auditor always use a due care very carefully. Due care. Auditor prepare the UVA. Audit the UVA, so-called statements, and give the opinion true and fair view. If the shareholder of UVA find out the thing is the big misstatements causing, the report having some issue, shareholder can sue auditor for the evidence of the due care. But if banker, for example, UVA have a very big bank loan from one of the OCBC bank. OCBC bank, just say for example, OCBC bank is a lender to this ABC company. Okay, every time one of the conditions for OCBC Bank to support the ABC company is every year I want to see the auditor reports. A lot of time they will come. Of course, auditor know about it because auditor responsibility is they have to ensure the banker still will be continuing to support or not. If not, they will put under going concern issue because it's a big issue, right? Correct? Agree for this, So auditor know about the conditions of the mean is they must ensure the thing is that these they know ABC must pass it to OCBC in order to continue the loan. Okay, if the banker send these confirmations to auditor about confirmation saying the thing is, OCBC Bank was just say, okay, dear auditor, dear sir, all this, it is to confirm that the thing is, the thing is, can you confirm as the financial statement audited for the ABC based in the opinion of true and fair deal, or confirmation about certain part of this auditor report? Should the auditor respond to OCBC Bank?
Yes.
How about you? Well, if you are the auditor, will you be responsible to OCBC Bank? No, you cannot respond to OCBC Bank. Once you confirm you are providing the due care already, you are not to confirm. You cannot, because you only to one reason, because he is your paymaster, not OCBC Bank. Remember this, due care is important. There will be some time in the question also, due care. Because
But how if let's say bank to know whether that report is true or fair?
no, the one we don't order. As an auditor, we don't order that. We just said, no, we only correspondent with that shareholder or the audit committee. We will not responsible to other people. Because once you respond, whether, whatever you respond, you are creating the due care. Because you give the confidence to the third party. Say, but the account is, audited and based on the opinion professional of true and fair deal. Anything happen here, suddenly the banker will sue you for the loss. Yes. That's why the thing is, auditor is not easy. So the thing is, don't confirm anything unless it's, that's why you can see auditor always ask this management to have a written representation, written confirmation. Why? Have to protect. Have to protect. Because somehow, not a lot of documentation can be fake also. Can buy the invoice, can do a lot of funny things. So as an auditor, that is a care we have to confirm. So due care, you also know about it. So the thing is, we will have to be ensured the thing is the due care we are properly care of. So as an auditor, we make sure. Okay, so next slide here, we will talk about express the opinion of whether the financial statements are prepared with this respect according to this solely report to the shareholders. This solely report to the shareholders. Then the thing is, of course, the thing is not everybody need to prepare this engage the external auditor coming in, and it's not cheap. When you need to engage the external auditor. Okay, why do you want to have engage the external auditor? Of course, everyone first question they will say because I want to get the bank loan. Bank only recognize the audited reports. Yes, it's true. Even though those we are fall under non-statutory audit. Why is statutory audit and non-statutory audit? Because one is that by law you must do it. That is under SSN, Sdn Bhd. You will have to file. And then only thing is, even though you are under SSN, doesn't mean that all the things even your these revenue are not fall under it. This one we will come back later. The only thing is here we will say small entity exemptions. You no need to comply. You no need to have an audit. So this one is that is certain parts. By law, you have to prepare. But if your total revenue less than 10 million, or the thing is your total asset less than 10 million, then you no need to
do auditing.
Do audits. You can just file based on your accounts. So you don't need to do auditing. So then you don't need to do auditing, you also cannot get a bank loan. That's the problem. Because the bank always look at the audited Okay, so but how about non-statutory? Why the thing is, club, charity, and then the thing is the partnership, sole trader. They no need, they are not fall under non-statutory audit. They can choose to audit or they can don't audit as well, especially the sole trader, sole proprietor, or partnership. Because audit is not a legal entity and all the income is assessed based on the owner, based on the partners. So because y'all, just few of y'all join together to do it. Similar to these how about the club? Why the club not involved? The club income really is contribute from the members. But certain time the club members, they have do the restaurant open to public. They must have a certain rule because the thing is, if you sell to public more than a certain percentage, you have to be taxed for the profits. Can I still remember all this? Because all this is a rule and regulation for all this. Yes, auditor must know all this. That is an important part. Okay, so here is we will talk about this one. Okay, how about the advantages of the non-statutory? Because the partnership, you can have these settlement account between these partners. You just prepare the current accounts, and then the thing is your profit you just share among to every partners. When you come for the closing, you must go for the resolution account, prepare resolution account or realization account, partnership accounts, realization account. So then from there you distribute all the assets to every individual based on the percentage. So here is when the audited account are available, make the account are more acceptable for the tax authority. Of course, these okay. Auditor they have two. Auditor is only for these so-called audit the financial statement. How about taxation? Taxation is different. Taxation we classify as non-audit work. Right? Taxation account will be separate by the tax agent. So the one is we will consider non-audit works. Audit work is only for the financial statements. So that's why, and here we will also learn about how many percentage of the non-audit work is recommended. You're not beyond to prepare beyond the amount because otherwise you will be not independent. They have a lot of rules. Okay, audits on behalf of sleeping partners. Sleeping partner is useful. Generally, is such person who have a few other means of checking the account and business for the share. Okay. Auditor is good for the sleeping partner because they are not involved in the business. So that's why the thing is the third party, if audit the account, the sleeping partner will feel more confidence, more fair, because somebody checked the account on behalf. Otherwise, if you are sleeping partner, the partner just mentioned to you, hey, this year we only got profit 10,000. In fact, is it sure 10,000? Because the person is sleeping partners. They are not involved in the management. They are not involved in the business. So they do not know. But if you engage the auditor come and do it, of course they are more confident, more comfortable. Because somebody checked through whether is it the profit is only 10,000. So okay, now today, why the thing is assurance have to come up. My time when I mentioned to you, my ACCA I completed in the year 2000. 2000, correct, 20 years ago.
Wow.
And at the time, when we are studying the audit, we don't have the assurance, you know. We don't have the assurance. We just audits only. We don't have audit and assurance. I completed my SCCA 2000. We don't have the assurance. Now, its only thing is because assurance is people, you know, it's an additional assurance to this so-called shareholder that auditor will have to follow all this in order to give a confidence level. I assure you, my audit is we are really go through the go through the standards operating system, all this. Otherwise, because the World Bank, Bank of Bahrain, all closed down, bankrupt. Why? Didn't bother, all affected. Because auditor do a lot of the unprofessional works. One MDB also kena, you know, KPMG.
Oh.
Because they cover off, because by pressure of the government, cover off. So we find by, I think it's 200,000. That's why we wrote KPMG. Yeah, because the thing is, that's why where is the assurance? Because the thing is, yeah, we engage you as an auditor to do the audit, you give the opinions, you know, true and fair view. But the company still bankrupt. How? Yeah, the bank is still bankrupt. So, World Bank, these are not World Bank, Lehman Brothers, Bank of Bahrain, of course. Okay, so come for the risk assurance. We will say the thing is, that's why what standards are you applying? You know, auditor must make sure the thing is what standard are you applying. You know the thing is why the US and UK, the standard they are applying, they are using the GAAP. Both are GAAP, but differences are, you know, GAAP, General Accepted Accounting Practices, General Accepted Accounting Principle, Practices. This one is principle. What is the difference? US we call principle. UK we call practices. Sorry, US is practices, practices. They are two. They are all using the same. US is principle, practices. Okay, because the UK, we are follow the UK. UK is practices, right? Cool. Can't recall. How about? UK is principle, right? UK is practices. US is principle. Okay, practices. We came up with the frameworks, accounting framework. You have framework is the law say standard you have to apply. If you don't apply, you justify why you don't want to apply. That one is UK standards. So but US principle is rule based. You have to apply. Very strict.
That's another way.
So that's why the thing is, and then how you have to apply rule based. When you say rule based, then the thing is standard. One standard cannot fit to all industry. That is the reason a lot of loophole. That's why US a lot of company bankrupt because the auditor also don't know where to classify this. You know, the rule based, the principle. They have 11 GAAP. For US, you have the 11 principle. You have to be followed. So that's why they are very, very complicated in the US system. So, but in the UK, we are more based on a framework. You follow, you don't follow, you justify. That's all. So that's why here they will say what standard should be applied. The second is represent good and acceptable. Which one is unacceptable? And then how much checking for these, you know, for these so-called should be done for this. You see, the green one, the big bear there behind. Okay. Okay. So that's why you see. So audit is one of the form of assurance, because the thing is that's why the thing is you will follow based on what accounting standard. Of course, in Malaysia we will based on the Malaysia accounting standards. Now the thing is we are using the MF, Malaysia Financial Reporting Standards. That's why the thing is we are start using the financial reporting standard. Previously we always use the IAS because the one is international accounting standards. But now all the reporting we will change to MFRS. And then every time when the Malaysia they change this, they have a new MFRS, they will publish in the newspaper about the new rule. They have to publish. So to announce that the thing is this standard is start, because they are published by MSAB, Malaysia Standard Accounting Boards. So you can see MSAB always have published, in the newspaper. In the Chinese newspaper only Nanyang. They put under Nanyang. In the thing is in English, I think the Star or the Star. Yeah, only one language, so here you will see whether here is assurance is defined what independent examinations of and expressions of the opinion on the financial statements of these entity of an entity by the newly appointed auditor in post-appointment. So important word is the opinions. So that's why they will go for the entity about these so-called appointed auditor, say express the opinions. And of course independent is an essential underline. So the main parts, when you give the assurance, people want what? Independence. So that's why audit assurance, they go for the 5 category. Independence is the most important. And then in order for the independence, what you will have to ensure, you got the 5, So CREST, crash. Crash, okay, C is what? Criteria. Suitable criteria. What criteria? Crash, CREST, we'll say. Criteria, accounting standards. What accounting standards you are using? The things or investment appraisal. Investment appraisal. Especially when you do a lot of investment, you must know, what kind of the classification. Okay, I ask you a question. What is an investment property and a non-current asset property? What is the difference between these two? You buy a property.
Investment.
Why you classify under investment?
Investment receive rental, right?
No, investment is you are intend to dispose anytime. You are intend to dispose anytime. This one is for the next 12 months, you will not dispose. So they are different. So when you hold the property, you hold everything, when the right time you will dispose. So what you have to do, every time you must revalue to the fair value. Up and down, you must recognize, especially when they're down, you must recognize the losses. So that's why investment criteria will be different with the normals. So this is the reason why the thing is investment appraisal is needed. So that otherwise the thing is, everything you put under current asset. Then, in fact, a lot of investment is very fragile, especially COVID-19 now. You can see everything is dropped. So the share market, how you classify? So that is the reason why you know that these Hin Leong Singapore, the oil trading company, Hin Leong, because they invest in the share, liquidated. Why not? And the one is how many years is very big company, you know. Hin Leong Limited, Guam also, Singapore recent one, because they invest in share and then trading, especially the forex. That's not because a lot of people is playing forex, is happening this. Okay, how about R? R is what? R will be more on this what? Three party, okay, three party, THREE, three party relationship. Three party relationship. So, okay, here, suitable criteria. Let me see, just put in first. As suitable criteria. Criteria is here, sufficient, appropriate, sufficient. Put it all first. Returns. This one is assurance. Assurance is from the appropriate, reasonable. This is a reasonable assurance to a reasonable engagement. This one is engagement. Opinions. Fine. Appropriate subject matter. Financial statement, appropriate subject matter. Then suitable criteria. This one is subject matter. Relevant. The crash is what? Let me see. Returns. So appropriate. R is what?
Reasonable.
Relevant. E evidence. E is engagement, sufficiency, sufficient, appropriate evidence. S is subject matter. Sorry, my mistake. Yeah. Evidence. E is evidence. Okay. Correct. Suddenly confused. Okay. Right? We talk about this three party. Okay, just now I mentioned to you what is a three party relationship. Your three party relationship is which one?
Auditor, shareholder.
Yes. Shareholder, management, the directors, company entity, and management and the practitioner. So first one is the practitioner. Practitioner. Then after that, responsible party.
Management.
Party. Then after that,
Intended
intended user.
shareholder.
Who is the intended user?
Shareholders.
Shareholders. Yeah. Or their trustee. Responsible party is the management. Practitioner.
Audit firm.
Okay. Then the thing is they will talk to these criteria. Criteria is more on the standards. We will talk about standards. So okay, then the subject matter. Okay, here you will have financial statements. How about others? Yeah, okay, now let's say for this. Okay, when come for this, okay, you will engage the auditor. First one, for your financial reports. This one is called statutory, correct? That is compulsory, you have to have statutory. And sometimes you will engage the financial this auditor to do the non-audit works. For example, acquisitions. You want to buy over the company. You know, you will engage them to do their financial. You will ask them to do the financial statement also. It's not financial statement, we call due diligence. Due diligence means you're going to assess their value. For example, financial statements, but it's only for the certain part net assets value. Net asset value. Of course, when you are acquisition the company B have their own auditor to do the financial reporting, correct now? Financial statement. So this one is the company B auditor have done already. So you will buy over the company B, but before you confirm the deal, usually you will ask your auditor to go and assess, to check the net asset value. We call it due diligence, right? So due diligence. You want to assure. But in the law, you cannot say you don't trust the financial, you don't trust the auditor B. Auditor B is a professional, also qualifications as a practicing auditor also. So the thing is, you only can check is that you go and assess the value only, the net asset value. This one we call non-audit. When we subject matter, you are doing your financial statements, or you are being assigned to do these so-called to appoint to do the certain tasks, certain specific tasks. Is it right for you? Okay, as an auditor, now we question as an auditor your responsibility. Okay, now auditor A. They are doing for the financial statement A. Now, the company buy over the B, take over the B. They take over the B. Now they are in a negotiation for the value. Can the management of A ask the auditor A to audit the B account? Cannot. Because you cannot criticize their professionalism, because the auditor is professional auditor. So you cannot ask the auditor to assess, to redo these financial reports of the B, but you only can ask the auditor to accept only on a certain area only. Certain area only, right? You cannot ask a client because you have no right to get the deal until your takeover confirm. When you take over, then you can apply your auditor A to be the auditor for this. For the next one, not for the current. Unless both parties agree, you withdraw and come in. But one company cannot have two auditors. They cannot have two auditors. So that's why subject matter is important. Subject matter, first one is your financial statements. Second part is that you have been assigned. If you are assigned by this net asset value, fair value, net asset value, that means what the auditor have to do. Auditor only specific on the net asset only. The rest they don't bother. They are not bothered because they are being appointed only to this. So they will give the assurance only this part only. Only this part. The assurance is only a limited assurance. We call limited assurance. Only this part. So that's why this is the auditor's words here. Okay, next one, evidence. We call the things are sufficient. You must be sufficient evidence. How do you tell sufficient evidence? Okay, it's much depend on your audit risk. This one we were going through that part. Your audit risk. What is the risk that the thing is you are willing to take? First thing you must ask yourself as an auditor. Audit risk is inherent risk, detection risk, control risk. They were based on these two formula. Inherent risk because your system too complicated. Detection, your these are so-called your faults or whatever error, how frequent is, what is your control system, internal control, and then of course it's linked to your SOP control. That's like control risk. This is a control risk. This one is your how complication of your system, of your organizations. Detection. Detection mainly is people try to be frauds, purposely to be frauds. How do you detect that? So auditor must be know the industry very well. If auditor don't know the industry well, you cannot detect. Right? You can't detect it because auditor also don't know how to detect. You cannot detect. So that's why it's evidence. How okay, if you think this one is high, so the other one must be low as possible, so that you can have try to reduce your risk level. So this one we will all go through. Okay, how about this? The other one, relevance, appropriate subject, we done already. Written assurance from the appropriate with the reasonable assurance for the this opinion expressed. So you must give the opinion whether their reports, their judgment, is it the thing is true and value, and written evidence must also get it from the management side. So this side you just remember the crash, So just to simplify, to remember this one exam frequently came out for the assurance. So that's how you just now three-party relationship mentioned here. Appropriate manner is based on this subject matter, financial performance, non-financial performance. You will also see physical character, for example, capacity of the design. All this is different. So whether, like for example, we have mentioned about these net assets value, these. And some is also for the system and processes, example, internal control. Okay, when the thing is so long as non-audit works, is okay, this is the audit works. Subject matter, that's why you must know as an auditor, your assurance is based on your audit work or non-audit work. Non-audit work is a limited assurance. Limited only for that area. But your audit work is your key, your audit assurance.
So what is non-financial performance?
Non-financial performance, for example, your this so-called how happy of your customer do the survey, satisfaction of the students. Staff turnover, how fast, how happy of the this. All this is we call
Financial performance.
non-financial. Okay, so this is the part. Any other questions from this? And appropriate subject matter is identifiable. Now this is your evaluation criteria is on this. What kind of the criteria reporting, control or reporting and compliances. Okay, all these is okay. Any question? We will talk about characters, relevant. here we will say suitable criteria. For the list, relevant criteria contribute to the conclusion to assist the decision making for the internet user. Relevant criteria. So the criteria is by the internet user. Why? Why the thing is relevant criteria is contribute to the conclusion that assist decision making. Because when you show your list of reports, what the internet user will do, whether they want to invest or they want to dispose their investment, they were able to ensure, because you can see the these we call internet user investor. What they want is maximize the benefit. If your company to show the financial report is not up to the expected amount, of course they will decide to dispose the investment, to sell off. Or if your performance is good, they are able to invest more into your company. So they will make the decisions on this. Completeness is what? So the thing is sufficient completeness, the need is relevant, could be affect the conclusions. Complete. So the need is your report is the criteria is completeness, the need is everything. Okay, when we say completeness, when the audit, when we always mention about completeness, is the thing is during this period of time, this is your accounting periods, your financial periods. Why the thing is January or even February? Why we have the 30-month adjustment? You know when you do the audit account, 30-month adjustment. Why this period we always call 30-month adjustment? Some even 40-month, depend on your process. Because they are based on the accrual basis. Certain time, your invoice you issue here on this date, so you have to put it back. Certain time you have the advance, so you have to pull out. So accrual basis. That's why we try to be completeness within the period of the 12 months. Whatever you, it's not based on the cash basis. What is the difference between cash basis and accrual basis? Cash basis is, when we say cash basis, when I make payment, I will record. When I don't make payment, I will not record. Accrual basis is whether I make payment or receive payment or not, I will record first. That's why it's more completeness. We call completeness. And then to show your performance is really within this 12-month period, really is a true, it's called true figures, true performance. Reliability, of course, whatever your subject matter reliability, how reliable is, you must have a source of the document. You must have the source. We always will be consistent evaluate of the subject matter. For example, your this valuation. Who is doing the valuation? You cannot say your boss do the valuation. A lot of people say, my director confirmed that building is 2 million. Based on what ground? So you must get the value. Those people, the market value to value. That person must have a qualification that accepted by the industry. You cannot simply say, director said 2 million, so we will just bring 2 million. So that's why this is the key part. Okay, next one. Neutrality is more on the what? Free from the bias. You are not biased at all. So it's neutral. You are not said because of the auditor, you give the assurance, you make sure that thing is you are neutral because the thing is you just get the professional fee. But the thing is, in fact, nowadays auditors, they will also, the thing is they roughly will know because of the industry. You say bias, it's not say bias. You say it's not bias, also not called no bias. It's up to the individual. A lot of time is the thing is if our relationship is very good, you will really use it. Will you go to the client side to really go and check 100%? No, I will just based on the treatment. But is it bias? No. For them, certain times say, hey, it's convenient, it's good, it's not bias. So how you justify the bias? So that is the part, neutral. So of course, from our part, auditor also, when they assess the risk level, they feel your risk level is very low, so it's okay. So they don't need to come to your side to check. I ask you, if your annual turnover is 100,000, do you think they will come to your side to audit? So, no, you will not. Unless it's 1 million. Because you must know, auditor charge based on the turnover. Also, so if they come to your side to audit for this 100,000, how much they will charge you?
Correct.
So auditor will fee, they will based on the two criteria, the hours spent and your turnover. So that's how you can get this audit fee only 1,000 ringgit. So understandable. Everything must be understandable, clear, completeness, and not subject to the significant differences. This understandability is the most important. The reason why. That's why the thing is when you are using the same frameworks, you are understanding about. You can see your this a comparison this year, next year, this year, previous year account. Understandable, comparable. Because everyone follow the same format. Okay. Any other things? Let me just get marks. Okay. Okay. Can you hear? Okay. Now the evidence. So evidence, we are mentioned about what the evidence. So the thing is, auditor always, when you see the auditors, they always will ask. They were suspicious. We will not call suspicious. We call skepticism. Means that you will know. You will keep asking them to get all the information from this part. It's not really the petitioner assume everything is dishonest, but they try to ask for all this information to be disclosed. So auditor will ask, but the thing is usually they will ask for the first few years only. Subsequently, they will just become the record. Unless you keep changing the auditor, then they will ask the same question. So here they say, sufficient is the measure of the quantity of the evidence. All this is a very long story, but the thing is, the reason is when they try to find the evidence, they can use these few items to find out the evidence. First one, they will be interviewed, asking when they try to get the evidence. an interview, they were asking a lot of questions, they will ask why, observation. They take a look, they see, do the sample checks. That is what they can get, observations. Then they also will do under what? Observation. Then there will be questions. Then the thing, of course, they can from the list all parties, even the customers also sample checks. From here they will find the evidence. And the last one is somebody reported. We call whistleblowing. Is that the one somebody give you the information? Whistleblower.
Yes.
Blower. Whistleblower. 告密者. Someone will just say, hey, something wrong. 告密者. All this, that is the evidence we can find. Interview they found, and they keep asking you a lot of things, observations, sample question, and reported by the third party. So you can see here. So the assurance reports, they will mention about, you must have a conclusion. In our opinion, internal control is efficient. A limited assurance engagement is what? The thing is negative. For example, based on our works described, nothing comes to our attention that cause us to believe that internal control is not effective in all material based on the XYZ criteria. So one is you have the limited assurance that we say nothing has to come to our attention. So that's why the thing is here. When you come for the audit works, auditor, when the auditor here, we will say audit works, we will give the reasonable assurance. Reasonable assurance. But this is a limited assurance. We call this one limited assurance. Because they only have a limited, nothing comes to our attention.
So there is only two assurance.
Two types of assurance. One is a reasonable assurance engagement. The other one will be a limited assurance engagement. So there are the positive, the financial statement through this one negative is not a good sign. We have discovered nothing wrong with this financial statement. The forecast is not unreasonable. There is no evident discrimination. That's why when you come for the list, you will also have a positive and a negative kind of assurance. One is okay. So you always remember in the UK system, whatever the feedbacks, you have two, one positive, one negative. Same thing like we just remember the marking system. In the UK system, we always very funny. Positive marking system, you write, got marks. Negative system, you wrong, minus mark. They give you 100% first. This one start from 0. Then if you do something wrong, they will minus your mark. Do something wrong, minus your mark. Negative system. Positive, you correct, they will give you marks. You wrong, they will not punish you. They are not punish you. So same thing here, the positive assurance. They will always say financial show a true or failure. Pass. Because nothing wrong. But here, negative, we have discovered nothing wrong. So they got nothing to deduct. Okay, pass through. Because I give you 100% first. But I can't find anything wrong. I can't find anything wrong. So that is a negative assurance. So depend on, that's why you just remember Positive is they will just tell you you pass. You know, financial is too bad, too failure. There is nothing to be deduct, nothing to be come to our attention. The financial report is having an issue. So it's just based on this one to remember how you can do this, how you can differentiate about the positive and negative market, the system of the UK. So so here negative is the basis of the forecast is not unreasonable, because there is no evidence of discrimination of the appointments. So you can give the two kind of assurance, whether you want to give positive assurance or negative assurance methods.
But what for the assurance is the same thing?
Usually, what you do, audit words is a positive assurance. When you are not audit word, it's a negative assurance. Because you try to find anything happen. Other people already examine, nothing happened. So because your boss wants you to go for the net asset and audits, checks, so you will always give the negative assurance. That's why it's not saying you can choose. Usually the reasonable audits, reasonable engagement is be positive. But limited assurance always is negative. Limited assurance always negative. So that's why you just remember this. Limited assurance is negative. Okay. So any other questions or not? You got any questions or not? So far, no. Okay. So come. So when come for this one, we will say that negative assurance always known as the limited assurance. Positive always is reasonable assurance. So that's why here is indicate about this. Okay, you can see the case study. When you are alone, when you do everything all, you no need to have the engagement of the assurance auditor or this. But when your business going great, you have the investor coming in. That is a place people are not trusting each other. That is a place when you need to engage the independent party to assess, to give a true and fair view of the report. Because the investor is sleeping partner. So this is how you just take a look about this. That's why he mentioned that this the investor is coming in. So people invest into the business now. That's why people have a majority of the share. So we come for the this. The solution is the assurance. Peter is saying can be given the independent audit or review because he is a major shareholder. He owns majority of the share. And the thing is that the Vira is the one who manage the thing is the running the show. So what the investor want is to have an assurance. The salary paid are fair. Okay. So this one is you just take a look at for this one because the thing is how this case study mentioned about the parts here. Okay, next one we will always talk about it. When you come for these your stakeholders, okay. When you are starting the ACCA, what is your main objective? because you want to be a management. That's the main part. When you are doing the management of the company. So management is the entity, we call entity. Okay, when your organization is set up, you are not doing yourself alone. You must have face to a lot of the people, creditors. You face to the public. You have the team of the shareholders. You have the directors. You will have the debtors. You have the employee. You have the government. All these are look at you, because so that's why the thing is when we say we are in the organizations, stakeholder is the most important. Everything you do, you must think about the stakeholder. Okay, so the thing is when you are you start from the F4 until even you start from F1 until now, you will all talk about stakeholder because you are dealing with the human. You are dealing with the human. So that's why the stakeholder is very important. So that's why for these exam, the ACCA always focus on the stakeholder. Remember, whatever you do, you just think about when you are the management, how you react to your directors, how you react to the shareholder, to your creditors, to your public government. So that's why the thing is the examiner, they like to do a lot of journal about the stakeholders elections. Did you all read the My ACCA journal? You must go in and take a look up. Look at the letters. You can go and select because when you all register with the ACCA, you can access to your particulars. Try to read these journal, these articles. Always will be the exact things, topics. Then they will not run away from the stakeholders because you are dealing with them. So that's why this one is I extract from some of the articles about these stakeholders, especially professional paper is the worst. All stakeholders, you have to analyze all the stakeholders. Here is still at least you are very focused on this part. Okay, so you can see that now we will take a look about this. So the thing is cover the range for these parts, internal policies. Here is the stakeholder accountability. What the mean is the accountability. The quality of these stakes in this accountability. Accountability usually we will talk about what is that? Answerable. You are able to answer question. Whatever I ask you, you are able to answer, to prove it, then that is your accountability. If I ask you a certain part, you cannot show me the proof, you cannot answer, you are not accountability. Answerable. That is accountability. So that's why the thing is, whatever we mentioned about here, director accountability. Director must communicate to all these profit variances warning. They also must knowing the going concern disclosure. So you can see, that's why the auditor, when they give the opinion, they will always, financial statement, they will indicate the director statement, communicate up. If there is a warning, they will have to disclose under these so-called, you can have a disclosure note or you will mention about emphasis on the subject. You say the profit warning is happened, but you still can qualify. qualified this report, but you mentioned is a profit warning because of the factory has been turned off, due to whatever thing outbreak is coming. The only part is the going concern disclosure. That the thing is that is quite serious because when they have this going concern disclosure, I mean for the next 12 months, most likely the company cannot survive. Unless you can get a loan, you can get everything, your cash flow is managed, then you are able to survive. Otherwise, okay, auditor always give the opinion. Remember, January 1st, December 31st, 2019, December 31st, 2020. Okay, you audit here. Your audit is this financial year. When the thing is, when they issue the going concern issue, I mean is you are based on the auditor professional view, professional judgment, your company cannot survive, during this period because the next 12 months. We audit always is we foresee the next 12 months. We don't talk about the 2021 because based on this one, I will measure your going concern here. For the next 12 months. That's why similarly, your non-current assets, I place under here, I don't foresee I will dispose before the December 31st, 2020. If I have intention to dispose, and then I think my price is reasonable, I think I have the person to buy, I will put under what? I will take out the non-current asset to non-current assets held for sales. I will specially put up the item, put it under non-current asset held for sales. So the mean is I inform this reader, intended user, this item is to be placed for the sales. So that's why they always look at the next 12 months. Next 12 months. If you want to sell after the 2021, there is no disclosure on this part. So remember, it's not forever. It's just look at the next 12 months only. That's why whatever the thing is, we will call the next 12 months. Just for the years. So at least you know what is this is so-called the sales. Okay, now here is just a summary, reasonable. You will conclude the express the positively. Reasonable usually will be positive. Positive. Limited always usually will be negative. So lower level of the risk and then engagement for forecast investment net asset is audit for financial statements. When you have the reasonable, in our opinion, the financial statement should trade value. Negative is nothing comes to our attentions. So this will be a limited assurance. So judgment. Okay. Any other questions for this? We will talk about this parts. Okay, limited auditing, not all item of the financial. So this one we will talk about the expectation gap. Okay, a lot of these people, the internet user, shareholder always say what he said the thing is, I expect the thing is everything you have, auditor will check free from everything. The meaning is, whatever I mistake, our staff do, auditor will able to find out. It's wrong. They expect everything perfect come from the auditor. Even last time my company's, my boss, they said, okay, auditor, everything, you just ask the auditor is super, everything can solve. A lot of people is take this way. They say auditor, can. So that is the reason. The thing is, auditor is only test on the sample basis. They will not check on this one. So that's why you have the expectation gap. So that is the reason. The thing is, when the thing happens, a lot of people blame the auditor. Say the thing is, you are medical man, you are doing a lot of things. So that's why here is believe the auditor tests all transaction and balances. They also believe the auditor will detect the outflows. They also believe the thing is the auditor is our responsibility to prepare the financial report. They believe the unmodified audit will guarantee the company is no concern. So it is the assumptions, expectation gap. So in fact, the auditor is doing the sample check. Auditor were not able to find out all the defect, but they were trying to use this mathematical calculation so that they are able to reduce the misstatements. And then who will be the preparing the financial statements? That will be your, usually is what?
Management.
Management will have to prepare that. So, okay, then the thing is, the belief that the thing is the unmodified audits, the opinion, guarantee the company is the growing concern. Okay, this one we will talk about later parts about modified, unmodified, about audit opinions, all these things. So, review engagement. So we will talk about this review engagement is more on what? More on the example of the limited assurance. So when the thing is review engagement is every time when the thing is the management or intended user asking an auditor to do a certain task. Auditor is very good experienced auditor will immediately so happy. Okay, sign. They must go and review first. Take this engagement, whether is it they want to take it or they want to reject. We call it review. So the thing is, so review usually is first thing you must see whether do you have competent staff. Competence means you must have experienced people. You must have a team. You also must make sure the thing is you are experienced in this industry. You know the business well. So that's why, and then all this will ensure your ability to perform for this. So the thing is the review engagement. And another one is like our auditor usually they will straight away give you this review engagement. I mean is they will say, okay, next year, you just sign next year also engage the same auditor. So continuous and auto review. So here the review here for the limited assurance, they will say based on the voluntary. See whether how you want to take it the limited. How about reasonable? Reasonable, the one we will talk in later parts. Because reasonable, you have to do a lot of things. The limited one usually is spatial assignment. One time, or sometimes these so-called non-audible we call. Okay, there are some company is doing the accounting services also. And then one thing is doing accounting services, second thing is doing the auditing, then another one have a consultancy, and then they also have, so the company can have an outsource HR also under the same company, HR, accounting, consultancy, training, all under the same. So in fact the thing is the whole audit firm, we call audit and accounting firm, is engaged by the same company. So and then under these practices government, we will mention how how many percentage of the non-audit works that the thing is non-audit work you should be accept up to how many percentage? Because if everything you rely on this same company can pressure you for the, even the audited report is not so good the performance. Then the boss will say, I don't care, you just change the figure for me, whatever way you want to do. Otherwise, I will pull up, I will find another person to do it. So you will lose the major income. So that is the reason why they have limited. They have set, the thing is the guideline, you should not more than a certain percentage of the non-audit works for the same companies, because otherwise the thing is that will be the key person. Okay, here we will talk about here is a review engagement voluntary, because sometimes you can do it analyticals, make inquiry, negative assurance. So analytical meaning, of course, you will do that analysis, inquiry, and then after that, once you've done this, then similarly is this. So we mentioned about this part. For example, if you get this limited assurance, okay, you accept, voluntarily accepted, and then you must do the analytical review. You must do the check about this the net assets, the depreciation, the current value is how much, and then you make inquiry, search for the markets, and then in the end you will prepare a negative assurance report. So this is how we call the review engagement, because for the audit we are more concerned about the audit side, the reasonable assurance, the limited assurance we just mentioned about now. After that we will not talk about the limited assurance thing. We all go through the main focus that will be our key topics. Reasonable audit works. So here, objective for this opinion here is they will just say the thing is they will mention the audit report is a standard report, copy from the same one.
Last year.
Sometimes there was one time my audit report they forgot to change the name. They put in other paper names.
Company name.
Yes, they forgot. Then I said, what happened? Behind, below is not ours. Then I inform the auditor, then they just change the name. So same thing, because they all copy. Why the thing is they copy? Why they use the standards? There is a reason. Because fully covered. All the item is fully covered. You don't try to use your other, you will miss on certain parts. Because whatever the standard format is fully covered, fully protected. So don't try to amend. And then you will different interpretation. Then in the end you will be facing some issue. So that's why every time they have a standard something. So they will say any quotes accounting records return on this is not information explanation, detail of director evaluations. The most difficult part for this audit is prepare these cash flow statements. Cash flow statement, you must measure the two you try to look up. Because accounting software, they don't prepare for you the cash flow statement. So you have to manually do it. That is the worst part. The rest is very simple. Accounting software do for you. But cash flow statement, I know they are trying to find out where the money comes, where the money goes. And classify under three that investment activity, financing activity, operating activities. And then have to work backwards to these cash earning. So that one take a lot of time, especially when your accounts very complicated, a lot of transactions. The rest is okay. Deferred tax is still okay. You just put it into the figure, they come up because deferred tax is differences between the corporate tax and now depreciations. So the one is still okay, but it's only in the cash flow statement. They take a lot. It's good because so far there is no computerized system able to do the cash flow. They can check, they can do the bank reconciliation, but they are not able to do the cash flow. Okay, now come. Take a look about this. This is the OT exam authentic test. So first one, we just take a look, exam question similarly. First one is A or B.
P1 something is A.
A. First one is A, huh? Second,
1, 2.
Second is A also, 1, 2, Third, this one is okay. International standards of the visa. Okay. Usually you know when come for this kind of question, simple. You know approval always will be the last one.
Sorry?
So number 3 always will be last one, approval. So
Yeah.
only left 2 only now. You can choose.
Estimation transfer general draft.
So the answer will be
D.
C.
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 Establishment
Why? The
of
thing is,
task
first one, number 4 first, establish a task force to develop the draft standards. And after that, you will discussion of the proposed standards at the public meeting. And after that, distribute the exposure draft for the public comments. And then after that, it will come for the consideration of comment received as a result of the exposure. This one is not follow the UK standards. Okay, how about number 4? Number 4 is
Shareholders.
number
B.
4. No, who normally appoint the external auditor of the company?
Audit
C.
committee.
Audit committee. Audit committee is the one who recommended and approved, not senior management. If you don't have the audit committee, who will be the next one?
Shareholders.
Shareholders. Because they will always at the AGM appointed. But who will be recommended? Senior management. Because senior management will get an auditor in first. AGM they will propose to appoint this because then they must majority agree. Okay, number 5. Most
External
appropriate.
audit. D. Sorry, A.
Now to give an opinion on whether the external auditor provide negative assurance, whether the company financial, this one. See that the external auditor perform the management to identify idea,
A.
A.
Sir, number 3, right? Where I need to find this information about this IAACFB members?
Okay, number 3 for these international standard accounting auditing, usually the standard, that is a process of it. So you can go to the website IASB, you can see website you can find these are the procedures or some other books, because once you go to the ISA, international standard of auditing, then they will give you, who is the key person, what is the
Procedures.
of this, and then what is the purpose. Okay, so far any questions? Not to worry, because we will try to, what we will do is, we will try to complete and then come for the revision, we will revise the thing is another book, do the revision, and then size for this part. So by the example, you can sit for the exam for the example. So for the example exam. Okay, right? Okay. Any other question? So the thing is corporate governance. We talked about the corporate governance. It's the practices that the thing is we usually apply for the corporate governance. We will talk about this. Why the thing is you need the regulations. Regulations. So here, so for the regulation, you can see here, whatever all this. So, you know, now we are talking about audits. So why the thing is, you must have a regulation. Who is mentioned about auditor? Who can become an auditor? All this is all must be under the regulation. And the thing is also will be put under the corporate governance. Corporate governance usually we are mentioned about the best practices in the market, how people perceive the good practices of these so-called the procedure for these audits industry. That's why for the corporate governance, we mention about, yes, you need to have an audit committee. Where is the audit committee? You need to have the audit committee. So when you have the audit committee, the means is you are able to solve any dispute between the management and the audits, you know, to solve. And then who's supposed to be sitting in the audit committee? Who's supposed to be sitting in the remuneration committee? So all this will be put under corporate governance. Okay, when we come for this corporate governance, so the thing is, same thing, we will come back to this. So for this UK, they have a framework, they mention to you, yes, you must do this, you must do that, they propose to you. If you do not to follow, you justify. But the thing is, for the US, you are not, because you become a principle. It's a rule-based. We will talk also about this part. So we mentioned here the needs of the regulation because of what? So the thing is continued trust of the auditing professions. So the thing is we will call harmonization of the procedures. So you know the procedure, you will have a set of the rules, and then you will focus on the audit quality, ethical codes, so that the thing is professionalism. And then the thing is, the guide is what we call national corporate law, set under this Savannah Act, Oxley Act, as well as the auditing standard and the code practices. Okay. The Savannah Oxley Act, SOA, is because the thing is, at the time the World Cup is, okay, you know the thing, the process. Greenbury, okay, during this World Cup collapse in the UK and in the US, collapse, US World Cup collapse, as well as the Bank of Paris, Lehman Brothers collapse. So in the US, then they realized because of the principle GAAP. So and then by the time then they enforced to have the Savannah Oxley Act after the Greenbury these acts, then they will came up with this Savannah Oxley Act. That is in the year of 2008. By at the time, you know, this one you can, I can also So next week I will give you all these. Here have not on all these the cases Savannah actually is namely they enforce. The thing is the chairman who are appointed in the audit committee must be responsible. So long as you sign, you don't say you do things, you must be, they will take action against the management team. Even though, you say, no, I just signed only. So once you sign, then you are responsible. So it is how they came up with X is. So, and then from here, you will have all the standards goes up. So, okay, in these corporate government, only thing is for the AA, we are more on the UK corporate government codes. This one. And the other one is OECD. So this one is quite important. And then they will focus only on these two. For this exam based because they always will mention about UK corporate government codes. I think it's for the practices. Okay, here we will talk about why it is needed for this one. So the problem of the back corporate governance is that of those shareholders own the company, the day-to-day directors, these are not to the boss. In large company, the shareholders, as if with the board of directors get more the free rein to make away the decision. Because if we are the corporate governance, there is no monitoring process. Anybody can just do whatever they want to do. Especially the chairman and the CEO, they have power, they can misuse. Nobody can be able to control them. Okay, the reason very simple. The thing is now, if you keep the illegal workers in Malaysia and Singapore, same thing. You rent your house to the person and you didn't go and check. You do not go and check who is staying inside your house. If the immigrant people find out the thing is your house of illegal workers or they do illegal things, who they will take the actions?
Owner of the house.
Huh?
Owner.
Yes, the owner of the house. Why they don't? They take action against the owner of the house. It's your responsibility to ensure your house is occupied, people is with the legals, as well as they are doing the correct legal activities. So why they want to do that? Because a lot of times owner will say, no, I don't know, I just went to one of them, they bring all these people. In the end, you cannot catch them. In the end, the thing is whole process the problem comes. So if I go against the owner, I solve all the problem. So thereby same thing. For the auditor, the thing is if you don't have the corporate governance, the means is every time the CEO or the director of this management team, they can do whatever they want to do, They can do whatever they want to do. They can misuse. So who will be the sufferer? The shareholders. Especially the minority shareholders. That is the worst part because they will be affected by this. So that's why auditing is an institute. So at least once a year. So here is they will mention about this opinion on this whether true or failure. Because you see, when the audits, what the auditor? So during this year, auditor came out how many times? Okay, let's say January, December. Okay, this is the first year, financial year. Okay, here. Then the thing is you will have June. Okay, auditor will step in when? First appointment, auditor will step in, usually will be here. date. January they will come in. So they will audit until the audit got signed. That is in the 1st of June. Let's say 1st of June they complete. This one we call final audits. Then the next one they will continue here interim audits. After that they reconfirm again. So they will come in July, until December. Then after that they will continue again. So this will be your final audits. They will rotate in this way. Right? First audit, usually unless during the time your existing one is still you are the first year, so they might be coming early to check first. If you are new appointment from the meeting is at the end, then you will come in here to do the final audits and then here. Okay. So if you don't have the corporate governance, whatever happen here during this period, the directors can do whatever they want to do. Auditor coming is too late because auditor is checking the past records. Right? Auditor is audit the past records. Auditor is unable to control, unable to mention about how good is the management, how good is the employment, how good is the product, how good is the customer. Auditor is only check the past records. Auditor is only check the past records. Whatever has been happened, they will check. So the thing is, if the director is not controlled by the certain part of the ethics, certain part of regulation, then they can do whatever they want to do. So when they come for this auditor come and audit the time, it might be too late already. Agree? Because okay. They will report to the list. Okay, you see, the most common, the thing is here, most common, when it comes for the list, auditor will facing what? Auditor will facing a lot of the misstatements. For example, your this tender, is not proposed for this, so-called misstatements, and then they got a lot of frauds. They got a lot of mistakes. Happens. So that's why the thing is, for the big company, you cannot wait until the auditor come in, find out all these issues. So that's why under the corporate governance functions, the thing is, you must have the internal control. If you are listed company, you must have an internal control. Internal control department to really monitor, to set up the SOP, clear SOP in between. And then the thing is, auditor coming in are able to use your booking papers to check that this control risk, to ensure your detection risk and your inherent risk. These are all these three form your audit risk level. So that's why the thing is here, when auditor coming, if you don't have the proper control, and you will find the thing is your account is a lot of mistakes, frauds, mistake, and it will impact to your financial reports, and the intended user will be, feel, they got lack of confidence on these so-called management team. So that's why your corporate governance is not just for the audit. The corporate governance is between for the auditor as well as this management level too. So These 2%. Okay, my class. Or a bit confused about the list. William, you okay? Alba, 3 of yours.
Okay.
No, the corporate governance is important to the management because they are trying to regularly control the management actions to make sure the thing is you are following the rule and regulations. Because this is to protect the shareholder, the intended user, to ensure the thing is whatever the investment is in, the thing is they can get their own returns. You know. So the thing is, if you don't have the corporate governance, the mean is you will know rule and regulation. Who is the most powerful now? Is the director is the most powerful. Director can engage anybody coming in to be a directors. So the thing is because the shareholder give the power to the directors to operate the business, to operate to operate the company. So that's why it's fully give the authority, and the shareholder only can attend once a year only. That is during the AGM. So that's why they have to control the management, make sure the management follow the ethicals, and they also have to ensure the auditor is also compliant with the corporate governance in order for them to do it more professionally, independently. So that is a key part. Okay. So here we will say the thing is auditor is only come at least once a year. When the financial present to the members of the company, the auditor will examine them and give the equation of opinion to the members. For this.